You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. We are talking to Sebastian Mallaby, who is the author of More Money Than God, which was published by Penguin Press. More Money Than God, Hedge Funds and the Making of a New Elite. Sebastian Mallaby, first I'd like to welcome you to the show.
Great to be with you.
Sebastian is with the Council on Foreign Relations. He is the director of the Maurice Greenberg Center for Geoeconomic Studies and is a Paul Volcker Senior Fellow for International Economics. He has a broad expertise in globalization, trade, foreign assistance, hedge funds. He is currently a Washington Post columnist. He also has been a Washington Post editorial board member. Previously, he wrote the book The World Banker, a story of failed states, financial crises, and the Wealth and Poverty of Nations, which was published by the Penguin Press. Among others, he was the Washington bureau chief for The Economist, the Tokyo bureau chief for The Economist, and has certainly traveled the world studying the economies all over the world. So once again, I'd like to welcome you. And I'd like
Great to be with you. Yeah.
Just to start with a question, the term hedge fund gets batted around very loosely. And I think that oftentimes people just think of it as some sort of glorified mutual fund. How do you define a hedge fund?
Well, that's a very good question, because if you put 5 financial experts in a room, you might easily get 5 different definitions of hedge fund. But the one I go with goes back to the first man who announced that he was running what he called a hedged fund. Hedged, not just hedge. And this was Alfred Winslow Jones, who, by the way, was a fascinating character. He had been posted as a State Department diplomat in his around at the age of 30 to Berlin, just as the Nazis were rising to power, and he fell in love with a beautiful German anti-Nazi activist and started to run clandestine missions against Hitler underground. And so that was the background of this guy who went on in later life to set up this first hedge fund. And his definition of a hedge fund was basically 4 things. First of all, you pay the managers an incentive fee. 20% of any gains on the portfolio is kept by the managers, and that really gives them an incentive to go out and figure out a good way to beat the market. The second thing is that you've got to manage your risk, so the managers have to have their own capital in the fund and to be penalized if they mess up. And then the third and fourth things are that you combine 2 techniques. One is hedging, which means that as well as buying stuff that might go up, you sell stuff in advance that might go down, so that you could be neutral as to whether the broad market goes up or down, but you have a view on particular stocks being strong or weak. And because you've hedged out general market risk, you can expand the specific risk you do want to take by borrowing money or using leverage. So those 4 things: an incentive fee, money in the fund by the guys managing it, and then hedging and leverage. These are the 4 characteristics of a hedge fund. On
the incentive side, if someone has a hedge fund, perhaps not even such a big fund, if he raises $20 million or $50 or $100 million, it seems as though for him to make a very nice living, it might pay for him to take huge risks that might not even be so prudent in order to get his 20% incentive fee. Isn't that perhaps almost an added risk to the mom-and-pop investors who put their money in?
Yeah, that would be right if the hedge fund manager didn't have his or her own money in the fund. But so long as the hedge fund manager puts some money in the fund, or his own savings are on the line, then, of course, taking crazy risks means that you're taking crazy risks with your own savings. And I think that's the key disciplining factor. So to anyone who is thinking of putting money into a hedge fund, I think the first question has to be to the manager, how much of your personal savings are going to be on the line next to my savings?
I got it. So your partners in the deal. The populist media today portrays hedge fund managers kind of as the root of evil and the cause of the financial breakdown. In your book, More Money Than God, you argue that that's in fact, not true, and that the hedge fund managers may be the salvation. How did you come to such a radically different conclusion?
Well, I think by just looking at the facts. I mean, the truth is that whereas most participants in the financial sector, whether you're talking about banks or broker-dealer investment banks or money market mutual funds or insurance companies like AIG, most of these types of institutions had spectacular blow-ups in the financial crisis and had to be bailed out by taxpayers and proved to be extraordinarily costly for the broader society. Hedge funds were really the exception. You know, in 2007, when the crisis began, they were actually up 10%. In 2008, they were down, but they were down half as much as the S&P 500 stock index. So they really came through the storm well. Taxpayers didn't have to bail any of them out. And that's been true throughout their history. There's never been a cent of taxpayer money that has gone to bail out a hedge fund. And I think, you know, given the costliness to society of the rest of the sector, we should be positively celebrating the guys who manage risk and do it privately without a government backstop.
What about the unusual bailout that you saw many years ago of long-term capital management?
Yeah, I'm glad you brought that up because it is the one that people do cite. And the point about that is that the Fed in New York convened a meeting of the bankers to long-term capital management when it lost all that money and encouraged the bankers to put their own money in to stabilize the hedge fund. But no public money, no taxpayer money was involved in that deal, and it wasn't going to be. I mean, if the private sector lenders, the banks, you know, which included, by the way, Lehman Brothers and Bear Stearns and all those guys, they'd lent money rather carelessly to long-term capital. And if they hadn't wanted to recapitalize it, the New York Fed would have just let long-term capital go under.
I see. We are talking with Sebastian Mallaby, who is the author of More Money Than God, which was recently published by Penguin Press. He is also a Washington Post columnist and a real expert on world economics and especially hedge funds. As an investment advisor, I work with clients all the time, helping them develop portfolios that are balanced and that are designed to meet their personal goals. Though I do the radio interview once a week, my day job is the day-to-day job of being a financial planner. One of the things that people often feel is that the hedge fund managers are somehow have the possibility to invest, or they're more magical. It's this feeling that there's something special about them. Is that actually true, or are we perhaps witnessing some kind of black swan effect where we just happen to spot them because they stand out occasionally?
You know, I think there is a sort of particular intensity about successful hedge fund managers. I mean, the whole setup, it's like entrepreneurs anywhere. I mean, if you go survey people who start up their own companies, they're not going to be usual people. They're going to be more intense, more driven, more ambitious. And it's the same thing in finance. If you go set up your own entrepreneurial boutique investment management company when you could have just worked for a big bank, or you could have worked for a big mutual fund group, you know, the people who go independent are probably going to be more obsessive. And that is a quality in markets that you need, because anything can go bump in any night, and you've got to be ready for anything. You've got to be vigilant all the time about what could catch you off guard.
Isn't it kind of hard to study the results of how the money managers do? Because sometimes a hedge fund will go out of business and then it no longer is on the scales and doesn't get measured. So it creates some sort of bias in any study. That's right.
So there are databases that collect numbers on hedge fund performance, and you have to treat them with a grain of salt because, as you say, there's a survivorship bias in these data, because if a hedge fund simply stops reporting because it went bust, then it just drops out of the numbers. And equally, when hedge funds begin reporting, it's often after they've had a very good year. And so there's a kind of what's called backfill bias, where you get a sort of unusually good year in the first year that every hedge fund joins the database, because it's the good year that prompted them to come in. But there are studies, notably by Roger Ibbotson at Yale University, which correct for backfill bias, correct for survivorship bias, and really take a close look at what a big group of hedge funds delivered over 15 years for clients. And what he finds is that even after subtracting those enormous hedge fund fees, there is alpha, there is positive return, not correlated with any other benchmark like the stock index, which investors do capture. So it's a good deal for big institutional investors to go into hedge funds, and that's why they've done it. That's because the clever advisors who consult with big retirement plans and endowment plans in the United States particularly, have read the economic literature. They know it's a good deal, and that's why I think assets in hedge funds tripled in the last decade and will probably triple in the coming decade too.
You're referring only to institutional investors. How do you feel about regular people using them for their retirement savings?
I think you have to have a lot of assets to make it worth it. I mean, the beauty of investing in a hedge fund is that it's going to give you diversification as against, the obvious things that you could put your money in, whether, a broad index of bonds, a broad index of stocks. You're going to hold some cash, you might hold some commodities. And the question is, do you want some of this unusual type of skill-based return that hedge funds are offering by playing currency markets, by playing specific stock selection strategies, by understanding bankruptcy regimes in different countries? They're offering a kind of skill-based return. And they're charging a lot of money for it, and they generally don't want to take your assets unless you're going to put in a big chunk of money. I mean, in excess of $100,000. And so you have to have, in order for that, to put that much capital into a hedge fund, you don't want all your eggs in one basket. So you sort of need to have a pretty big amount of savings, I'd say, upwards of $2 million, $3 million.
How about these fund of funds that do that diversification for you? So with $50,000 or $100,000, people could spread out the risk amongst many funds.
Yeah, that's worth considering. I mean, the thing to be careful about with fund of funds is, first of all, what extra fees are they layering on top of the hedge fund fees? Because, of course, they're going to charge for their services. So now you're paying high hedge fund fees and the fund of fund fees on top of that. And then the second thing is that, there's a mixed record with funds of funds. And when the Bernie Madoff scandal took place, it was absolutely shocking that some apparently reputable fund of funds had put their clients into Madoff when there were so many red flags around that. So, you have to do your due diligence on the fund of funds that actually claims to be doing due diligence, because they might not be.
I see. Okay, we have been speaking with Sebastian Mallaby, who is the author of More Money Than God. Just as a final question, maybe you could tell people how they could learn a little bit more about the work that you're doing, or answer the question, who is the person who should be reading your new book? Well, I mean, my book has already sold quite a bit. It's a New York Times bestseller, and I think that's because it appeals to anybody who's fascinated by markets, and also by the sort of the intersection between markets and government policy, because there are stories in there about the way that John Paulson in the subprime crisis messed up when he let Lehman go down because he didn't understand the reaction function of hedge fund investors and markets. But I think it's an endless source of fascination. The markets are broadly efficient, and yet this special class of investors, the hedge fund people, manage year after year to beat the market. How do they do it? They must have some extraordinary quality, and that's the culture that I try to capture and describe in my book, based on 3.5 years of going out and talking to people in the industry. Wow. Okay, well, it looks fantastic. I would like to once again thank you for joining us on the show today.
Nice to be with you.
And I wish you luck in both this book, and we're looking forward to your upcoming books as well.
Okay, terrific. Thank you.
Take care.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.